I don't know why bankers are so boring. Today's Valentine's Day and I can hardly see any red around, barring one lady here, probably two. Coming to SMEs, it's, I think, been one of the most debated industries or sectors of the economy in India. You know, we always talk about big corporations, unicorns, indices, but we normally miss what lies beneath, and that's the engine which chugs the Indian economy, which is the SME space. I don't know how many of you know, but SMEs contribute about 40% to India's GDP, about 50% to growth, and roughly about 40-45% to India's employment. So today we'll cut through the noise, we'll talk about what makes this sector interesting, what are the do's and don'ts, what one should look at. And I'm joined by three very talented and impressive fund managers who've got a very good track record. So I've got with me Abhishek, Mohit, and Rishi. So, you know, we'll ask questions to them and try and understand the sector much better. So, whom should I go with first? Let's go with Rishi first. So, Rishi, you say that you reject more deals than what you invest in. So, what are the parameters that you look at for a SME company to become part of your portfolio or to reject a company? What are the main triggers that you look at for identifying a company?
Am I audible? Yeah, I think a little louder than normal. Okay. So we are actually in a very voluminous space. You know, the four of us, even today sitting here, we would have got about 10, 20 deals. Some companies at pre-IPO, some coming for IPO. In this voluminous space, you are bound to reject more ideas than what you can see. If I just give you context, about 5,000 plus companies are listed in India, all companies. In the microcap space in which we are in, below 4,000 crore market cap, which is roughly $500 million, there are about 4,000 companies. If I take the very small ones away, less than $10 million market cap, you're still left with 2,300. So that's already listed, and we are expecting 230 companies at least to come to markets every year. So 10% CAGR is what we have on supply side. So what we have seen in the last 1.5 years in our fund, 1 on 5 companies tend to be investable. Now other factors like all the other great fund managers mentioned about price, promoter, governance, tailwinds, headwinds is what factors in for investment. There are 3 stages of investment for us. One is pre-IPO, which is what we're expecting to get to IPO. Then second one comes anchor, which is you're trying to underwrite the issue at the beginning. So you have to look at what stage you want to invest at. Sometimes you invest in all 4, sometimes you wait for a couple of stages and come back a little later. There are more don'ts. So a few of my analysts are in the audience and they would see that we have about 80-point checklist of what not has to be done. But and what tends to happen for us is we eventually create biases. So just the other day we were saying, sir, ये तो IT company, अब तो IT is continuously doubtful, इसे छोड़ देते हैं. Like, no, our job as fund managers, we are paid for a management fee only to analyze every company and not just to say, ये IT company है, छोटी है, छोड़ देते हैं. And we went in and we saw it's not any IT company, it's a product company. What's the use case of the product? The promoters have been in this business for the last 25 years. They were working somewhere. Now they've just launched the product out of 4 years of experience and investment. So for us, it is all about getting down to the last bit of it and trying to unlayer every unknown, which is why it takes us so much time. We take about 7 days per company. In 15 analysts, we analyze 30 companies in a month. Typical don'ts would be that don't invest into a company which says that there are 5,000 people doing in India. I will capture the market and become a national leader, because up until now you yourself a regional leader, and unless you have shown that yes, there is value at scale, every fragmentation in commodity business cannot be captured. Second would be a me too. Just because you've had 10 companies listed in last 10 years or 3 years of solar, and you come up and say, I also want to open a solar business, give me money. So me too easily fades out because the derating has happened on PE, the margins are going out. So these 2 factors are there, and I'm sure others will tell you more.
So coming to Mohit, Since you come from Heme Securities and kind of you have a different side view as well in terms of looking at the IPO. So, while Heme Securities being one of the largest merchant bankers in the SME space, while you're taking a company to the IPO or Heme Securities taking a company to the IPO, when you look at investing, what would you do? Is there a bias or, despite it being a Heme Securities IPO and you'll choose not to invest in, why would that be?
Okay. So as far as the investing is concerned, I believe all three of us are on the same side. We are on the investment side. So the merchant banking team is entirely different. The team is different. The task is different. We have a very strong Chinese wall in place as well. So that criteria doesn't match here. At the same time, what we typically look into a company is the business quality of the promoters, as well as if the company has the potential to grow at 30-35% CAGR for say the next couple of years or the next 2 to 3 years. So through an example, I would like to show you what do I mean. So suppose if a SME company is trading at a PE of 15 and giving a PAT of 10 CR, so the market cap is going to be roughly 150 CR. If the company has a good quality or a niche business or something unique and the sector tailwinds are there, we try to analyze, can this company compound at 30-35% CAGR in terms of its revenue, operating profit and PAT for the next 2 to 3 years. If it does that, the PAT becomes close to 25 CR in 3 years, and by the virtue of fast growth, it is likely that the company will get a higher P than the rest of its peers in that sector. So its PE expansion scope is also there. Say the company trades at a PE of 25 because it's growing at 35% CAGR. So you get benefit of both PAT expansion and PE expansion, and the market cap explodes to say north of 600-625 CR in a couple of years or maybe 2.5 years. So the kind of growth is 4x in this example. So that is what we are trying to identify company at a nascent stage, good quality of promoters and business, some uniqueness, sector tailwinds, and a scope to grow faster than rest of the peers.
So on a high growth, we've had like almost 2.5 years of crazy bull run or huge tailwinds, and then last 20 odd months, it's been lackluster, especially for small cap stocks and SMEs. So from that angle, Abhishek, you've delivered fantastic returns. And how much of that, if I have to kind of dissect that, would have come from the growth in the earnings or, companies growing at a 30-40% CAGR, and how much of it would have been from timing or early entry into the stock or a pre-IPO?
I think definitely that's a great perspective. In the inception years of FinAvenue to the current stage, we would say retrospectively, if we dissect the earning profile, 40 to 45% of the returns would have come from mere earnings growth, but 65% of the returns would have definitely come from re-rating of the market. Gentlemen, it's very important that we all understand that in the nano cap universe, liquidity is something that essentially drives up the market. Why so? Because as the top large caps or the mid caps, once they get stable, when they believe that, okay, the market and everything is doing smooth, the money keeps flowing down and then the micro cap picks up. That is why you will always see that after every bearish cycle, the micro caps, they run up last, but they run up real big. So back when FinAvenue started in 23, since October 22 to March, there was a one-sided steep fall, and sometime during between March to April period, the market started going up. We started the fund around July. Most of the IPOs, the SME IPOs that FinAvenue did, the average entry multiple were in the zone of 14 to 17, and to 85% of them, we exited somewhere between 35 around. In some of the rare cases whereby the sectoral tailwinds got super steep, or I would use the word madly crazy, we even exited at around 55 multiples. And from there as well till current point, the prices are still up 30% on an average.
So, given that you started your fund a couple of years back, especially when you give capital to a small company. When I look at the IPOs which have happened, let's say last 1 year, in the large cap space on the main board, almost 65-70% has been OFS and way less going to CAPEX. If you look at SME, bulk of it has gone to CAPEX. Wouldn't that be exiting early, considering that, you've just given capital to the company and you need to see it through the cycle? CAPEX will take time, new plant will take time, so you should give it time.
Absolutely, but if the market is pricing something very fast, if the price has already discounted the next 2.5 years of earnings, would it be wise to hold it? It's a very important question that we as fund managers should ask every day. But at the same time, if in the next 1.5 years the price is not going to go anywhere, would you hold it? I mean, it's an honest question to you guys. Or would you keep looking for a next round of opportunity to redeploy the capital? That's a very interesting thing to ask to Rishi or to any other. When it's a follow-on thing.
In fact, that's what I was thinking. So, we talk of asymmetrical risks in investing, and the returns also have been sometimes over the top. So, what do you look at in terms of asymmetrical risk, managing that, especially on the downside? And, what Abhishek said, if the stock has run up too fast, too high, we'll take our money off the table.
Hello. Yeah. This is a typical behavioral investment problem, right? Behavioral finance will tell you that when something goes up 4x in 3 months, you're likely to sell it. I think the point in contention should be, and we have seen that in our portfolio as well, if something has come up for 10 PE multiple and it deserves a 20 multiple, in trailing PE, forward PE should be fairly between 5. So you're expecting 4x anyway. So what we have started doing is, and Abhishek is right, you'll end up selling it as a fund manager because आपका 200 return बन गया, get the capital back to cash, look for something else because you are spoiled with choices. 250 company आनी है हर साल, you better be spoiled with choices. Having said that, what we now started doing is every quarter end, we start looking at companies purely objectively financially, and what we also do is we put a peer analyst on that company so that we have antithesis and thesis. If the antithesis are lesser, we then re-rate it considering, okay, if we hold it even now, or we sell off 1/3 of the position, keep the 2/3, and we hold it, let's say 6 months more, is there likely to be a re-rating because XYZ is going to happen? And whether my XIRR at a 3rd year of earning still retains to be 20% plus. If those two math works out and an event happens which can completely re-rate your industry, the entire defense was a down story until Sindoor happened. I remember 4 days before Sindoor, all defense companies were selling off left, right, and center because everyone had the liquidity issue. Sindoor happened, and now you have another wave. So these black swan or white swan events is what I call it for SME. You never know what they happen, and that is the time you feel FOMO. अरे यार मैं 4 दिन और रख लेता, 2 हफ्ते और रख लेता. And we have seen a 20-30% drawdown in the last 2 months. And then many times we have felt what to add, what to sell. Adding at those times is more important than selling when you're 4x. So it has to be mathematical decision. Many a times as investors, we feel, why is Abhishek buying this when I already made 4x? So we should also validate ideas. And we have had a couple of calls saying, yeah, this is this, what's that? So many times you don't get to see the entire story because the story is much broader than your attention span. We have an 8-second attention span now because of mobile phones. You at least need 30-40 minutes of detailed attention to understand why what is moving.
And what work does happen at the ground level? Because, the sector is such, these are very small companies, not tracked by analysts. Unlike the main board of the top 1,800 companies, everybody tracks them. So what is it, I'll ask this to you, Mohit, what is it that different you do, what others don't do, or what you have to actually do to invest in SME or small companies which are not tracked by anyone, and data points as sparse and few?
Great question, Vinayji. So, as you began off the session by saying that SMEs are capturing 40% of India's GDP, that isn't in any way reflected through the market caps right now. SME market cap is not even 1% of the market cap of India, right? Now, SMEs, investing in SMEs comes with risk. So it's a high risk, high return zone. And since we spoke about in the first question about the positives of investing in SMEs, that you can multiply your money, it comes along with certain risks. Now, risks, the volatility risk is not the real risk. The real risk is corporate governance or the quality of business. We should focus on, and we should apply our common sense also, that if that business has sectoral tailwinds and organic tailwinds to support high growth, this should be followed by taking a call on the promoter as well. What is the purpose of IPO? Does he need that money to expand in terms of capex, or maybe he needs working capital? How much is he invested in the company, the skin in the game, which we say, right? What has been the track record of the promoter? How are the financial doing in terms of margin genuineness, in terms of operating profit margin genuineness? So all these things are to be filtered out, figured out and studied, and we should refrain ourselves from judging a company on the basis of its narratives. That is a very key learning which I'm pretty sure all three of us also have. And judging the business organically based on strong fundamentals, having clear entry and exit strategies, that is something which can protect us. Because, 40-45%, I was reading it somewhere, of the listed SME companies are, trading below their issue price. So it's a high risk zone. You need professional approach, clear approach to make money. But if you go right with the selection, there is serious money to be made in this space, and people have made a lot of wealth, built a lot of wealth in this space.
On your last point, so, I think that puts the fund managers or larger investors at a huge advantage, and probably a normal retail investor at a disadvantage, because they don't have the wherewithal to actually research and do site visits, etc. So what would be your advice for retail investors in terms of the potholes that they need to be aware of, or what are the points they should take into consideration when investing? You just said like 45% of the stocks are trading below the IPO price.
Yeah. So if a retail investor or an HNI investor feels that the company belongs to his maybe domain knowledge, if he has some advantage of domain knowledge, he can study the company at depth. What we suggest is a very strong and a deep dive research into the company, not on the basis of narratives, but on the basis of genuine business and genuine business potential. And if you are not able to do that, you can obviously go for fund houses like us who are specializing in this domain and who have the capability in terms of a research team, experience and market knowledge to crack this entire space for you, right?
So, before talking about how the funds have performed and, how we've delivered, each of you have delivered a fantastic returns to the investors. What are the mistakes that have happened? I would, ask each one of you, without naming the stock, where did you go wrong, and what were the red flags probably you missed, and what are the learnings from there? All investments don't make money, considering 45% are trading below their IPO price. And, we all do make mistakes. We are humans, we are not gods. So, Abhishek, starting with you.
Every business, there are a couple of risks, okay? There are some risks that happened at the balance sheet level.
If you wish to name the stock, you can, but I would love to know the mistake.
I can name the sectors where it has happened. So mistake number one, it happened early in the journey of 2023 only, where we thought of investing in a stock which was in a counter-cyclical approach to us. The industry was going in a downturn, and we got in touch with a chemical company whereby everything was good. Okay, the profitability was at its worst, which we anticipated. Still, they were going to come with an IPO. They were going to have a listing, and then the funding was good, mostly on the working capital side, because they believed that by looking at the con calls and the whole valuation analysis of the chemical sector, we thought that, okay, the pricing are at the bottom. So maybe this new round of money that is going into the business and the underutilized capacity will ramp up easily, and the future profit can be in a very exponential manner high. 6 months later, a small player cannot take a very big advantage of a counter-cyclical sector. Okay, the leaders, they take care of everything. We lost 33% of the capital over there. So the learning number one, whenever you want to play counter-cyclical, stick with the leaders. Don't go in the small players. Mistake number two, in the electronics industry, we were sitting on a good game. Okay, management was doing upfront capex for a large order that was supposed to come from a European counterpart. Some things, of course, are happening at a global level, whereby due to one single person getting elected in some corner of the world, we all started fighting with each other, and a major order got cancelled for that electronics company. Now, what went bad there then? The upfront cost of inventory, they have to write off. The large depreciation on the books, the huge interest on the books, everything ate away their profits. In a matter of 3-4 months,
Those
the
are
profit got
black
up.
swan events which nobody can predict, right? Something happened. But what I'm asking is the fundamental mistakes that we as humans do. Which probably was the
Vinitji, but
first one.
at the end of the day, these are very small companies. Large fundamental mistakes will not happen there. I mean, unless and until it's an accounting mistake or accounting fraud, that's a different thing. But usually, it's the business that totally takes away your balance sheet. That's a very major risk. So you have to avoid the customer concentration. I mean, these were my two honest mistakes that we found out. Otherwise, at business level, we don't do. It was only the decisions that took out the company.
Yeah, because as fund managers, these are the acts of commission we have no escape from. Acts of omission we can always talk about, but acts of commission is what's critical. So, Mohit, what was yours?
Okay. So, sometimes we go with the flow of narratives, sometimes, I would say that there was a company which was coming into semiconductor space, and semiconductors was, I think, probably the hottest theme of 2024 and 2025. But it did not have a tangible order inflow at that point of time. It had plans, and the plans got delayed by a couple of quarters, and the stock crashed. So, if there is a narrative, we should definitely look into solid, well-defined, process-oriented, timeline-driven plans of the company to committing to what it is, to the kind of, it should commensurate the vision it is setting in the minds of investors. So seeing the actual growth happening, maybe we can be a little bit late on the entry side, but that is a cost which you will pay as risk-reward ratio. So not getting too much ahead of the curve or not trying to judge a company too soon to make faster money is something which is my number one learning from the mistake we made. And number two is, although it's $1 million question, but timely exit. That sometimes we are sitting on a lot of profits, but we feel that our story is right and we are getting rewarded in terms of our early identification, P expansion, PAT growth. But sometimes the underlying story or the theme is changing or transitioning, and that is the time to exit. And we miss out on that signal. And when the prices drop down by say 10-20% there, and they drop in a flash in SMEs, micros, everything, then probably we realize that बेच देना चाहिए था यार. These are the two things.
And yours, Rishi?
ये बहुत इंटरेस्टिंग था. एक ने बोला खरीद लेना चाहिए था, एक ने बोला बेच लेना चाहिए था, या खरीदना ही नहीं चाहिए था. But I think as a portfolio, so Vinitji, I have worked for 10 years in risk management. So when I came to SME sector, my co-fund manager and I, we had daily talking about risk and reward, risk and reward. हमारा रोज का काम ये था. After a point, you realize there's only X number of risks you can mitigate. Baki you'll have to live with. So we spoke about black swan event. We spoke about event investment. You have to size your portfolio right. You will make mistakes. And in our space, you will make 20% mistakes no matter what. 20% of your bets will underperform to your expectation. Not because what you thought, because some de-rating has happened. Even to an extent in our space, there is not enough marketability. If I tell you that Shikha is a wonderful asset manager, if she didn't get this platform, you would not know Shikha. The same thing happens in our space. We had such under-discovered companies that just that factor itself doesn't allow the stock price to move. And invariably, what happens, so we have made about 10% investments in pre-IPOs. We never crib about them missing their earnings. Why? Because that doesn't directly impact my stock price by half. If today's scenario, if a company misses its earning by 40 lakh rupees or 10% of the expectation, the stock goes down 20-40%. That volatility doesn't define our success or failure. So we have to look a little beyond 2 years or 1.5 years or 6 months. The criteria has to be at a portfolio level. We have 250 companies coming every year, 2,500 in the kitty who are listed. On that space, where can you make a portfolio which is fairly decent to protect your capital and give a upside so that investors see an alpha? So we just did a study in Jan end. So we publish a newsletter every 6 months, which is a 40-page newsletter. And this time was a second edition. So we thought कि यार हमने 30 ideas cover किए थे last time. उन 30 में से 10 विनीत जी लॉस में थे. And we were like यार ये publish कर देंगे तो कम से कम 200 phone call आ जाएंगे, 200 investor हैं, 100 तो आ ही जाएंगे. So we contemplated for a while and we went ahead. Because that is the report card which we also need to see for ourselves. Then we wanted to do a benchmarking. So we did some asset management discovery कि यार ये sharp ratio क्या होता है, Sortino क्या होता है. So let's apply it to our own fund, right? We are a decent $55 million fund. We have enough positions. We saw surprisingly our sharp ratio is over 1.5, which is very healthy. Our drawdown, which is our downward capture ratio, basically means that if Nifty index goes 1 rupee, how much you go? We go 0.4, which is 40%. So on both the risk parameters of returns, we are wonderful. Then why are we scared about? What are we scared about? The volatility will be there, which is why we have a sharp ratio. The returns are there. The downward side is protected. That means we are doing wonderful.
So what is the upside one can expect from your fund? So you talk about downside cap, and I'm asking this because I'm also an investor in your fund. So I have my money with you. So what's the upside I can expect, or returns I can expect, or investors can expect over, let's say, next 5 years?
So what we initially did, we tried to put the factor investing methodology when we started. Ki what factor can give you what risk and what factor can give you what return. So we estimated approx 10 to 15% alpha over our peers, which would be, let's say, top tier small cap mutual funds, because that would be our peers. They are fairly 5-10 times bigger than us on an average. In fact, our sharp ratio today sits better than them because obviously they are much more exposed, but you never know what happens next 3 years. So 10-15% alpha over them. So if they do -5, we'll do 10. If they do 0, we do 15. Last year they did -8, we did, on the DAIS, I should not say the percentages, but we've done fairly well. And I think that matrix will turn out because every risk parameter is mitigated by the downside and the upside. So it's not like we will do better than the index, because many a times we also sell our positions depending on the liquidity, depending on the sizing of position, number of positions. We typically cannot, how many ideas can you see, right? So you have to pick your bets and you have to churn the portfolio. We did 80% of our capital profit booking last year. And that was a very, very high churn we did, because we had to see, we also need to provide liquidity to the companies. If we take 5% of the company and we don't give some shares to ex-investors to buy, then when will we get a chance to buy them back when they sell at loss? So we also pump some liquidity, we absorb some liquidity depending on where our conviction is.
So when we talk of SMEs, we always also talk about Atmanirbhar Bharat and Make in India. So, Mohit, what do you think, which are the sectors you would invest in over the next 2-3 years, the sectors that will do well within the small cap SME space? Where would you place your bets on if you have to pick your top 3 sectors to put money?
Sure. So, given the kind of position India is in, we feel that precision engineering, aerospace, defense, data center, and some ancillary space of manufacturing side, which is not easy to replicate or has entry to barriers. These are some of the bets which we would like to play into for the next 3 to 5 years at least. Yeah.
And I'm sure all of you have taken bets and, made some exits also. As you said, you've booked a large amount of profit. So, for example, Abhishek, would you talk about a successful exit? Why did you exit? Was the timing right? What were the reasons behind exit? And how's the same stock performing now?
Yeah, so again, one more electronics company only. First of all, the thesis that electronics company from a small time EMS player, it was migrating to an ODM, original development manufacturing kind of a scenario. We entered around 160 at 18x multiple. Post our entry, the financials turned around whereby the top line grew by more than 55% odd. At the same time, the bottom line doubled in the next 2 years. At the time of our exit, the valuation was quoting at around 60x price to earning ratio. And we thought that, okay, this is it. Because by that time, the financials of the company, while it was looking good on a PAT level, on an operating cash flow level, it was deteriorating very badly. On the other side, the good things were happening. That company had got an AS 911100D certification. Their US arm was already garnering business over there. But still, I always tend to look at current valuation, can this company make a mistake and I can afford to live with it? Because the downside capture is a very big thing over there. So we exited, and from there, in the next, let's say 1.5 years, the price is in the range of 20% only. So I can still see it as a successful exit where I made money. I got a huge liquidity to exit as well, because for me, it was a good 3% allocation on the FinAvenue book. And to the AUM level, it contributed nicely around 4%, 4.5%. So at the end of the day, I believe it was a win-win on all the sides.
Since we are running out of time, so, a quick line from each one of you in terms of what one should look at investing in SME and what one should avoid, quick one line on each side.
If it's your full-time job, do invest into SMEs. It's a very interesting space, great promoters, and price discovery is given if you identify the right. If you don't go wrong, you will make money.
Do a proper capital allocation. Consider the amount you consider as worthy of investing in SMEs out of your total capital allocation, because ultimately everything is cyclical. SMEs also have their up cycle and down cycle. So a part of your investment should definitely go into it with an expectation of higher return given higher risk.
I think risk allocation is very important. So take it as a satellite portfolio. Think about 35 odd companies. Do not invest into them unless you have followed them real deep for the 6 months period.
Thank you everyone for listening patiently. I think, I always say no large cap was ever born large cap. At some point there were small companies which eventually became Adani or Ambani. So I think that's the way forward. Thank you everyone. Thank you so much.